Do you want to know the best way to sleep with your boss's spouse and not get in trouble for it? Being self-employed. Terrible jokes aside, this video is all about if you're self-employed, what do you need to know in order to qualify for getting a mortgage? Ready? Let's jump in. So I'm recording this video exactly 1 month from tax day in 2024. And the reason I wanted to make this video now is because one of the most common challenges that I see folks have is self-employed people trying to qualify for conventional mortgages. Because in Puerto Rico, there's no bank statement loans, there's no profit and loss loans. Those programs are not here at the moment. We're actually working on trying to get those here. And I might put some links in the description if you want to reach out. If you're self-employed and you really want bank statements, go to the description. I'm going to put some links in there that you can maybe send some messages to these folks to help facilitate bringing those programs. But anyway, at the moment, we only have conventional loan programs, and conventional loan programs only look at tax documents to calculate your qualifying income. And so if you're self-employed, you will already be aware that maybe what's hitting your bank account, it may not necessarily be what's getting reported. And I'm not like, that's not in any way an accusation. That's just like that's a tax strategy, right? So you can, come tax time, if you're self-employed, obviously we know that you write off a lot of expenses and then you pay taxes on what's left over. Well, if that's the case and you're only like reporting a very small amount after all those expenses, basically the trouble is that you can't tell Uncle Sam that you make one amount and then turn around and tell a mortgage loan officer that you make a different amount. That's the rub, right? Is that your tax preparer's job is to show as little income as possible so that it keeps your tax burden down. And my job as a loan officer is to show as much income as possible so that we can boost your purchase power, right? So these two goals obviously cut against each other, but thankfully, there is a way to make a plan. If you know these next couple of pieces of information, that I think can be key and could be the difference maker between you qualifying for the size of a purchase that you want to make, or you not being able to qualify for another year or two and having to wait a long time in order to be able to reflect the amount of income that you need. Okay, so the first thing that lenders are going to look at is your income stability, right? So you're probably aware of everybody that starts a business. If you fast forward 2 years, right, from the moment that people are starting a business and you look 2 years into the future, how many of those businesses are still operating? And of the businesses that are operating, how many of them are operating at a profit? And then fast forward 5 years, how many of those businesses are still going, right? So mortgage lenders, they know because they're looking at periods of like 30 years and they look at repayment data. That's really all they care about is the repayment data. And so if lots of self-employed people, if those projects many of them are not getting past 2 years or they're not being profitable, well, they see that in the repayment data. And so what they're going to look for is that in order for us to use your self-employment income, we're going to be looking at your tax documents over the last 2 years. So minimum, you have to have been self-employed or have been receiving self-employed income for 2 years, reporting it in your tax returns. That's number one. If you've been going longer than that, that's awesome. But it's going to be minimum 2 years. There's not any circumstances in which if you've been self-employed, like maybe, even if you're like working in that line of work as a W-2 salaried employee, like let's say that you're, I don't know, a software engineer working for a big company, receiving a salary, and then you switch and now you're independent contractor doing the exact same work, making the exact same money, that is going to be an issue. It's because you've only been doing it for 1 year on your own, and that's very likely not going to be sufficient. So the name of the game is 2 years of self-employed income minimum in the tax return documents. The other thing that lenders are going to look at is the location and nature of your business, right? So many folks who are self-employed these days, maybe they work completely online. Maybe they have a distributed team. Maybe the nature of the work is like digital and that they're doing it all on computers. And so they can do that from anywhere that they have an internet connection or their computer. And so they're going to look at that. However, if you're self-employed because you have a storefront, right, brick and mortar that is in some part of the continental US, and you want to come and purchase your primary home in Puerto Rico, obviously they're going to ask questions about that, right? They're going to want to know, can you manage your shop from a distance from Puerto Rico? And I've said this many other places and many other times, but I'll say it again, that it all qualifying, if it's for your primary home, it all comes down to your income and if your income will be in Puerto Rico. So if you're self-employed and your business is here in Puerto Rico, you're good to go, right? And you want to buy a primary home, no problem. We can set that up. But if you are self-employed elsewhere and you want to come to the island to buy a primary home, then we're going to need to make sure that it makes sense, right? If you can do your whole job remotely, cool, we can use your income. If you can manage a team from a distance, that's great, no problem. We can use that income. But those are going to be things, right? We're going to look at the continuity of the income over time and the nature of the business and the location of the business. And it's all going to need to be like documentable. So once we have your tax documents, right, what are we going to actually be looking for in those documents? So the name of the game is debt to income ratio. Now, our company, to get your debt to income ratio, we look at two things. We look at your total minimum monthly payments all added together, plus your cost of living expenses, plus the new future mortgage. So it's like all of your minimum debt obligations. So if you have any credit cards, car loans, student loans, anything like that, we don't look at balances. We could care less about balances. You could owe millions and millions of dollars, but if the minimum monthly payment is small, that's what we want, right? So we add up all those minimum monthly payments plus your new mortgage payment. And then kind of depends on like if it's for your primary home, well, we don't need to really include the previous home. But anyway, we're taking all of those minimum monthly payments and adding those together. And we're going to divide that amount by your gross reported income for the year, right? And so what it needs to look like is basically for most loan programs, that proportion, including the new future mortgage payment, needs to be less than half. Like all of your debts need to total of less than half of your monthly gross income that's reported on taxes. So this is called your debt to income ratio, and it's the all-important number that we use, and that's what we're looking at during the application process of, okay, you want to know how much of a house you can afford? Well, if you are, we go and we generate, okay, how much debt can we cram into your gross monthly income until we get to about that value. Now, we don't try to max and like completely stretch somebody's income all the way to that 50% mark. For one, it'll hurt you on the interest rate, right? Like lenders don't like seeing a high debt to income ratio. If it's at 50% or above really 45%, you're probably going to get dinged on your rate because that's higher risk for them, right? And so it's all about keeping your debt to income ratio low. There's two ways to do that, right? And so one way is to reduce debts or increase income. And so let's look first about reducing debts, right? So again, it does not matter the balances of how much debt you owe in total. What we look at is the minimum monthly payments. So for example, let's say that you have two debts, right, that there are of equal balances. Let's say $5,000. You owe two credit card companies each $5,000. One credit card company has your minimum monthly payment at $400, and the other one has your minimum monthly payment at $50 a month. Well, if you have $5,000 to use to pay off debt, so you're going to pick one of them, my recommendation as a loan officer would be that you pay off the debt, pay off the balance that's reflecting the larger minimum monthly payment. Because if you reduce all that debt, you've just opened up $400 worth of space in your debt to income ratio, right? And so like, we don't care about balances. We only care about what's the minimum monthly payment. If you're self-employed, one strategy can be like some folks, they have like a vehicle that maybe they bought on their personal credit, but that it's really getting paid for by the company. That's great. If you can show 12 months of consecutive payments coming out of an account that is for the business, then great. We can completely omit that. Even if it's reflecting on your credit, we can completely omit that auto payment from your debt to income ratio. And that can be a helpful strategy, right? But it's going to have to be 12 consecutive monthly payments coming out of a business account that's not a personal account. Other than reducing debt, the other thing that you can do is increase income. Obviously, that's probably going to mean reporting more income or even being strategic about what it is that you're reporting. Because as I'm going to say in another section of this video, that there's certain things that we can actually add that are expenses that we can add back as if it's income, right? And so I'll talk about that here in a minute. But that's the name of the game, right? Is that it's either reducing debt or increasing income. Those are really the only ways to improve your debt to income ratio. Another quick note is that if you've been self-employed, if your business has been operating for 5 years, well, we can do what's called a streamlined underwriting process. And there's loan programs that are called streamlined programs that only let us look back 1 year. Because if you've been operating a business for 5 years and generating an income, that is a very strong sign to the underwriters. And so then we can potentially only need to look at your most recent, your last year's of tax returns in order to source that income. So maybe if the year before was not that strong, you reported a low amount of income, and the most recent year though you'll be able to report a lot. That could be very favorable if you've been operating for 5 years or more, because then we could basically just do a streamlined loan program and underwriting process whereby we only look at the most recent year. Okay, let's talk about what documents you're likely going to need, because one of the, going through a mortgage process, it can sometimes be just like a scavenger hunt for some documents. And so this part of the video, I'll help you try to identify and start looking for the documents that we're going to need to either pre-approve you or to get through underwriting if you're already under contract, right? And so which documents specifically that you're going to need depends on the structure of your business and or the structure of your income. So for example, if you are a 1099, like if you're an independent contractor, that means that you're doing work for maybe different organizations, different other groups, and you're going to receive from those groups at the end of the year 1099s for whatever jobs you did, and no taxes, nothing's being taken out of those things. You're going to take all those 1099s together, and that's going to usually get reflected and reported on what's called a Schedule C in your income tax return come tax time. And so that's what we're going to look for, right? If you're an independent contractor, we're going to need your last 2 years of individual federal tax returns, or if you have Puerto Rico returns, same thing, right? Last 2 years showing that income, and we're going to average all the 1099 income over those 24 months to calculate what your gross monthly income is, right? So that's if you're an independent contractor. Now, if you have an S corp, right? There's more variety in terms of like which documents we might need, because some people who have an S corporation, they actually pay themselves a small W-2 salary, and then they pay themselves a K-1 distributions as well. Or some people only pay themselves a K-1. Regardless of which one you're doing, if you have an S corp, we're going to need the most recent 2 years of business tax returns, so 1120S's that have the K-1s in it. And we're going to need, if you W-2 yourself, we're going to need the W-2s, and we're also going to need your last 2 years of individual federal tax returns. Also, like, if you have these same types of documents, but you're living in Puerto Rico, we'll need your Puerto Rico local, state tax returns and the business state tax returns as well for the last 2 years if you have an S corp in Puerto Rico. If you have a C corporation, same type of thing. We're going to need the last 2 years of business tax returns and the last 2 years of your individual tax returns, whether they're federal or Puerto Rico tax returns. It's also very likely that you're going to get asked for tax transcripts, right? So they're not only going to want to see your individual tax returns that was filed, but that they're going to want to see that the tax transcripts, that's essentially like the IRS's way of confirming exactly what was filed, because unfortunately, some people will submit tax return like documents to mortgage underwriters, and then they'll actually file a different copy, and the IRS, so they like give the loan folks one version showing more income, and then they actually file less. So underwriters are hip to that little move, and so that's why they're going to also ask for tax transcripts. So like I said, if you're self-employed, it might be a bit of a scavenger hunt for these documents, but this is what we're going to need, right? It depends. Basically last 2 years of business tax returns if you have business tax returns, and if not, then your last 2 years of individual tax returns, whether they're federal or from Puerto Rico, those are the documents that we're likely going to need. So here's some general advice that I can offer about if you're self-employed. What are some tips that you can use to qualify, to show more qualifying income? Number one is going to be talk to your tax preparer, right? If it's tax season, before you go and file, tell them that you're wanting to qualify for a conventional loan, right? That's going to be really important information. Tell them that so that they can better structure and better report maybe more income, and also report more expenses that we can add back. Like I mentioned before, for example, depreciation. That is something from like, if you're able to report depreciation on your business tax returns, and on your individual tax returns, those are, if you're Schedule C, that's an expense that I can add back as a loan officer as if it's income, right? So, and again, it gets a little complex, but tell your tax preparer that you're wanting to qualify to purchase with a conventional loan, and they will know like which things and how much maybe that they can report for you. Another tip is pay off consumer debt. Again, with the focus being on the balances, no, excuse me, with the focus being on the monthly payment, not the balances, right? So if you've got a bunch of money and you're able to pay off some debt, pay off the debts that are reflecting bigger monthly payments, not necessarily the ones that have the bigger balance. If you don't know what are the balances, what are the minimum payments that are reflecting, you can go to a link. I'll put it in the description at aewholesale.com, and that is a safe spot where you can go and get a free copy every year of your your credit report, and it should stay on there for each of the open trade lines that you've got. It'll show the balances, but more importantly, the minimum monthly payments, and that's the ones that you're going to want to pay off, the ones that are showing the bigger payments. Another link I'm going to put, and this is just kind of like, for the moment that when we get to that point and we have to do a hard credit inquiry, there's an opt-out option so that you don't get inundated with telemarketer calls for credit programs and for insurance products. I'm going to put a link in the description where you can go and you can opt out of 5 years, because these days, if you're self-employed and you're applying for credit, they're looking for you. And so you might get inundated. So I'm going to put a link to help out with that too in the description, so you can opt out of at least 5 years of those kinds of like telemarketer calls and stuff like that. Another tip is that if you're self-employed, you can consider maybe making a larger down payment to reduce the loan amount, and that'll actually maybe help you close on the size of a purchase that you're looking to make. You are able to use, if you have business bank accounts, you're able to use those business bank accounts, the funds in those bank accounts, so long as you're able to provide the bank statements showing that, and that you might also need a CPA letter. If you have a CPA for your business, they might need to write a letter stating that the business will still be solvent after using all of those funds. But that is a possibility too, and making a bigger down payment can reduce your loan amount and help you get to the closing table on a bigger size purchase. And lastly, if your income that you're reporting is just not sufficient for the size purchase that you want, then you can consider using a CoSigner, right? That should be somebody who has strong credit, a low amount of monthly payments that they're paying on themselves, and a pretty good, robust income of their own, so to add onto your income. But that can be a real help. Sometimes we see, it can be a parent, it can be a friend, really anybody that's willing to have your mortgage reflecting on their credit, even though you'll obviously be the one responsible for those payments. Well, that's it, guys. If you're self-employed and looking to qualify for a loan, hopefully this video was helpful for you. If it was, please, maybe, and you're still watching after all this time, maybe give me a like or hit the subscribe button. If you have questions about your specific scenario, like you want to know how much money do you need to report in 2023, how much income in order to qualify for the size purchase, or do you have enough income, or what's the structure of my tax returns? Like, if you have any of those questions, guys, reach out to me. I'll put my contact info in the description, and I'll be happy to help advise. So please feel free to reach out to me. But anyway, guys, thank you so much for watching, and I will see you next time.